Yeah, so I mean, I talk about the three themes from a fixed income perspective, and then how we are managing that within Dynamic. I think the themes are probably similar ones to 2025, right? I think the market's been quite focused on AI, has been focused on private credit, and has been focused on the fiscal side of things. We've seen obviously lots of volatility in the longer end of government bond curves. With respect to AI, we've had and will continue to see a large amount of issuance from the hyperscalers, but also from other issuers. And we've seen pretty lofty valuations in equity markets, with a lot of optimism that maybe it doesn't play out. So, if credit markets struggle to take down that enormous amount of issuance, or if equity market valuations re-rate lower because the return on investment from this AI capex is maybe lower than people expect, there could be contagion. On the fiscal side, government spending is too high, and I think maybe that's become less of a focus in recent months, given other dynamics, labor markets and inflation. But that, I think, will continue to periodically pop up in the coming years. We're not expecting a 22 type sell-off in the gilt market, for example, but the net amount being issued to the markets on the government bond side is large, right? 2 trillion plus in the US, and the way that this is manifested, and we think will continue to manifest, is by seeing higher risk premium, building a higher term premium into government bond curves, and we can still, I think, expect volatility, particularly at the longer end. And on the private credit side, it's obviously a sector that has grown very quickly in recent years, and maybe there have been some concerns emerging about the quality of the underwriting. I think in some areas, not this is only related to, I think, a few areas. Particularly after Tricolor and First Brands and Jamie Dimon's comment about cockroaches in the space. So, in truth, we are likely to see more, quote unquote, cockroaches. This is the nature of, high yield credit investing. You can expect default rates to be, more than zero. The historical average in the US high yield market, for example, is above 3%. I think the thing that will most acutely affect that default rate in the private market will be what happens to the economy, right? And I think that default rate in private market will ultimately be quite correlated to the default rate in the public market. Yeah. So from our perspective, Dynamic has no direct exposure, to AI. It's obviously got no direct exposure to private credit. We don't have an investment where the return on that investment will be determined by the return on equity on AI capex. Yeah. We are not exposed to the vagaries of the long end of the government bond curve. We don't have any 30-year exposure in any currency, and of course we focus on liquid, public credit, and we do have a lot of liquidity, and we have flexibility. So I think in this environment in particular, maintaining that flexibility, maintaining that liquidity, focus on strong, rigorous due diligence from a bottom-up perspective, and you're very well placed to take advantage of any credit volatility if we were to see it.